Insurance providers. This lesson looks at the different organizations providing insurance protection today, sorted into two groups: private insurers and government programs. Private insurance providers. Private insurers come in different forms. While most people are familiar with commercial insurance companies, there are other types of organizations that also sell insurance. Commercial insurance companies. Most insurance coverage in the United States is written by commercial insurance companies. There are two types. Stock insurance companies. Mutual insurance companies. Stock companies. Stock insurance companies are owned by stockholders, just like any other corporation. The stock of these companies may be publicly traded on stock exchanges or privately held by small groups of investors or families. Stock insurance companies pay stock dividends to their stockholders. Stock dividends are generally taxable to the stockholder. Mutual companies. Mutual insurance companies are owned by their policy owners. Ownership is represented by the policy, not shares of stock. Like stock insurers, mutual insurance companies have minimum financial capital requirements and are governed by a board of directors. But a mutual company's board of directors is elected by the policy owners. Mutual companies issue participating policies, which pay policy dividends to their policy owners. Policy dividends, which cannot be guaranteed, are typically not taxable since they are viewed as a return of excess premiums. Policy dividends are covered in a later lesson. In recent decades, many mutual insurance companies have transformed themselves into stock companies through a complex and lengthy process known as demutualization. Other types of private insurers. Though not nearly as large as most stock and mutual insurance companies, there are other types of enterprises that underwrite and sell insurance, including. Please pause the audio and review the table. Let's look at each of these groups. Managed care service providers. While many stock and mutual insurance companies sell health insurance, an increasingly large share of medical coverage is provided through organizations called managed care service providers. Popular examples include HMOs and Blue Cross/Blue Shield organizations. These organizations blend characteristics of commercial insurance companies and medical care providers. Service providers are more fully covered in the health course. Fraternal benefit societies and insurers. A fraternal benefit society is an organization of people who share a common ethnic, religious, or vocational affiliation. These organizations have no capital stock, have a representative form of government, exist not for profit but solely for the benefit of their members and their beneficiaries, operate on a lodge system with a ritualistic form of work, may provide insurance to their members. Fraternal insurance companies are nonprofit organizations that are affiliated with a fraternal society and operate under a special section of the insurance laws of the state in which they are domiciled. They specialize primarily in life insurance and annuity products that are usually available only to the society's members. Home service insurance companies, industrial insurance. Structured as either a stock or mutual company, home service insurance companies distribute a class of insurance called industrial life insurance. Traditionally offered as burial insurance, industrial life insurance offers individual coverage in small face amounts, usually less than $10,000, in some cases, as little as $1,000 to $2,500. These policies generally require no medical exam to qualify, though some medical questions may need to be answered on the application. Self-insurers. A self-insurer is any organization that insures itself, typically by paying for smaller losses with its own money. It is an example of the risk retention approach to risk management. Practically speaking, self-insurance is a sound option only for large companies that are willing and financially able to pay for relatively minor losses that arise from self-insured risks. Businesses that self-insure their employee benefits must adhere to state and federal laws governing insured employee benefits. Risk retention groups. Self-insurers who want to share the administrative tasks of running a self-insurance program may join a risk retention group, RRG. Set up by insurance companies that provide self-insurance services to member businesses, RRGs give companies the infrastructure support needed to successfully self-insure their risks. Risk retention groups were created through the Federal Risk Retention Act of 1986. The act requires that an RRG follow the insurance laws of the insurer's state of domicile. It also requires that RRG members share a common business, occupational, or professional relationship. Surplus, excess, lines insurance. Surplus lines insurance is not a type of insurance company or product, but a market for insurance that is not available through any admitted companies in a state. Admitted insurers are explained below. Surplus lines brokers are authorized to look to non-admitted insurers outside of the state for coverage not available in state. Though the insurer may not be admitted in a state, the products it sells through a surplus lines broker must be approved by the insurance department of that state. Also called excess lines insurance, surplus lines insurance is more common with property and casualty insurance than with life and health insurance. Reinsurance. When life insurers underwrite especially large life insurance policies, they typically spread the risk with other insurers to minimize the risk they face should a loss occur. Called reinsurance, this is done through a formal agreement in which both the risk and the premium are shared with one or more other insurance companies. The insurer seeking to transfer some of its risk is known as the ceding company. The insurer accepting some of the risk being transferred is known as the reinsuring company. The ceding company pays a premium to the reinsurer for its share of coverage. When a reinsured loss occurs, the reinsurer pays the ceding company for its share of the claim. The policy owner may never be aware of this arrangement. Claims are paid entirely by the ceding company that issued the policy. Example: Excalibur Life Insurance Company has a reinsurance agreement with International Re, a reinsurance company. When Excalibur Life, the ceding company, writes a life insurance policy with a $1 million face amount, it turns to International Re to reinsure half of that amount. International Re will charge Excalibur Life a premium for reinsuring $500,000 of coverage. If the insured dies while the policy is in force, Excalibur Life will pay the $1 million claim and then submit a claim for $500,000 to International Re, which will pay $500,000 to Excalibur Life. Admitted and non-admitted insurers. Insurance is primarily regulated at the state level. To conduct business, insurance companies, as well as agents and brokers representing those companies, must be licensed or certified by the states in which they want to transact business. An admitted insurer is a company that has received a certificate of authority from a state where it wants to sell insurance. An insurer must hold a certificate of authority, that is, be admitted, in every state where it transacts business. A non-admitted insurer is one that is not certified to do business in a state. Only through a surplus lines broker can a non-admitted insurer transact business in a state. Unless it involves surplus lines insurance, producers face penalties if they solicit or sell insurance for a non-admitted company. Do not confuse a non-admitted company with an unauthorized company. A non-admitted company is a legitimate insurance company that does not hold a certificate of authority in a state. An unauthorized company is one that is presenting the products it sells as insurance when in fact it is not a legitimate insurance company. Domestic, foreign, and alien insurers. Insurers are classified by their location as domestic, foreign, or alien. An insurer is classified as a domestic company in the state where it is domiciled, that is, headquartered. An insurer is classified as a foreign company in every state outside of its state of domicile. A company that is domiciled outside the United States is classified as an alien company in every state where it is admitted. Example: an insurance company headquartered in Ohio and admitted in Nebraska is a domestic company in Ohio and a foreign company in Nebraska, as well as every other state outside of Ohio. An insurance company domiciled in Canada is an alien company in every U.S. state where it is admitted. Insurer financial status, independent rating services. One way to distinguish insurers is by their financial strength and claims paying ability, as measured by any of several different ratings agencies. Among the most well-known and respected of these ratings agencies are AM Best, Standard & Poor's, Moody's, Duff & Phelps. These rating agencies measure insurers' present and future financial strength and claims paying ability. Grades are assigned to each insurer based on various factors including capital, liquidity, management, competitive advantages, and ability to raise capital to finance its strategic plans. While the exact grades vary by rating agency, they generally range from A+, superior, to D, insolvent or in liquidation. Insurer marketing distribution systems. To bring their policies to market and to sell them, insurers generally use one or a combination of the following types of distribution systems. Career, or captive, agency system. This distribution system uses licensed producers called agents who primarily, if not exclusively, represent one insurer. There are two types of career agency systems. Managerial system. The insurer employs agents through regional offices, branches, or agencies. The agency head, called a general manager, or GM, is an employee of the insurer. The insurer is responsible for agency expenses and staffing. General agency system. The agency head is an independent contractor, called a general agent, or GA, who employs agents. The GA is responsible for agency expenses and staffing and is not an employee of the insurer. Independent agency system. Under this system, licensed producers called brokers are not affiliated with any single insurer but instead represent multiple companies. Their managers, sometimes called personal producing general agents, PPGAs, are responsible for hiring, dismissing, and managing the agency's brokers. Direct response system. Insurers using the direct response method sell directly to consumers, without the use of external agents or brokers, through mail, radio, television, and internet advertising. Direct response insurers maintain teams of licensed producers in corporate or regional offices that assist consumers who contact them with insurance questions and to buy policies. Note, at one time, the role of sales was strictly divided between captive agents and independent brokers. Today, agents and brokers are more commonly called producers. Functional divisions within insurance companies. Broadly speaking, insurance operations can be divided into four functions: marketing and sales, actuarial, underwriting, and claims. The marketing and sales division employs home office employees to promote, market, the product and licensed producers who represent the insurer and sell its policies. The actuarial division employs actuaries who calculate the insurer's premium rates, determine appropriate cash reserves on claims, and calculate policy dividends on participating life insurance policies. The underwriting division employs underwriters who evaluate completed insurance applications to determine the applicant's level of risk, and determine appropriate premium rates and coverages for that risk. The claims division receives policy claims, investigates them, and decides whether to pay the claim as submitted, reject the claim, or offer some other settlement. Government providers. Federal and state government social insurance programs serve an important social purpose by providing a minimum level of protection for all eligible citizens. These programs differ from private insurance in several ways. Coverage extends to all eligible citizens. Eligible participants receive benefits as a social right under law and not through a policy. Changes to benefits can only happen through changes in the law. Funding is through taxation, not through payment of premiums. Medicare Parts B, C, and D are exceptions since beneficiaries do pay premiums. Federal government insurance programs include Social Security insurance, more formally known as old age, survivors, and disability insurance, or OASDI. Medicare, formerly known as Supplemental Medical Insurance, or SMI. State government insurance programs include Workers' compensation, unemployment insurance, Medicaid, which is state-administered but federally mandated and subsidized, unique state-run medical insurance plans. For your review, mutual companies, owned by their policy owners, issue participating policies, which pay tax-free policy dividends to their policy owners. Stock companies, owned by stockholders, do not issue participating policies. Profits are distributed as taxable stock dividends to their stockholders. Industrial life insurance, sold by home service insurance companies, is sold in small face amounts, usually less than $10,000, and frequently between $1,000 and $2,500. Fraternal insurance companies are nonprofit organizations that sell life and health insurance to members of the fraternal society they are affiliated with. To conduct business, insurance companies, as well as agents and brokers, must be licensed or certified by the states in which they want to transact business. Domestic insurers are domiciled, headquartered, in this state. A foreign insurer is domiciled in a different state. An alien insurer is domiciled in a different country. Admitted insurers are issued a certificate of authority to transact business in a state. Producers should never sell a non-admitted insurer's products unless they are licensed surplus lines brokers. Federal insurance programs include Medicare and Social Security. State insurance programs include Medicaid and workers' compensation. Please pause the audio and watch the video. You can restart the audio playback at any time.
Insurance protection is available from a lot of different insurance companies. The company that you're going to work for could very well be a commercial insurance company. You may be going to work for a nonprofit organization, possibly a managed care company. Of the various types of commercial companies, the two that are the most significant and the two that you want to make sure you fully understand for your licensing exam are mutual insurance companies and stock insurance companies. Now, just a couple of general observations about those. First of all, either type, mutual company or stock company, can sell virtually any of the types of insurance products discussed in this course. And in fact, most of your leading companies are either mutual companies or stock companies. Both companies are for-profit businesses that collectively employ thousands of people throughout the United States. Both are equally subject to the insurance laws of all the states. And as I mentioned, both types of companies sell all the types of products that we'll be discussing in this course. Now, there are some important distinctions between the two, and that's what's important that you understand. The most important one is who owns the company. A stock insurance company, like any stock corporation, is owned by its stockholders. A mutual insurance company, on the other hand, is owned by its policyholders. Now, that itself is a significant difference. Now, let's talk about the types of policies that they sell. Stock insurance companies typically sell policies like everything that you'll be studying in this course. Mutual insurance companies typically sell a type of a product called a participating insurance contract. And that's a significant distinction of the mutual insurance company. A participating policy distributes what we call policy dividends. Now, those are not to be confused with stock dividends issued by stock companies. Another way to put it is both mutual companies and stock companies issue dividends. Stock companies issue taxable stock dividends to its stockholders. Mutual companies distribute a form of profit to their policyholders in the form of policy dividends. But whereas a stock dividend is a return of true profit and is in fact a taxable distribution, a policy dividend from a participating policy is actually nothing more than a return of, if you will, excess premiums. Now, the term used is divisible surplus, but for all intents and purposes, it's excess premium. Now, stock dividends are taxable income. Participating policies and their policy dividends are non-taxable. And there's a very simple reason for that. Life insurance premiums are not tax deductible. And therefore, it makes sense that if some of that non-tax deductible premium were to come back to you, you should not be taxed on it. That is the fundamental reason explaining why policy dividends are not taxable. One last point to keep in mind. There is no law that prohibits a stock insurance company from issuing participating policies. However, from a practical perspective, no company would do that, because if a stock company issued a participating policy and distributed something that resembled profit to their policyholders, you can bet the stockholders of that company would have something to say about that. So stock companies, for all practical purposes, do not issue participating policies.
Okay, everybody, so we're going to take the quiz on this lesson here. All the following statements are regarding reinsurance are correct, except the insurer seeking to transfer some of its risk to another insurer. Reinsurance is a risk-sharing process. The insurer accepting some of the risk being transferred from another insurer is known as a reinsuring company. Claims are to be paid by the policyholder separately by each insurer participating in the reinsurance. I don't know. I'm going to guess. Seriously, I don't remember. I was focusing on stock and mutual and like in that video, so I don't remember anything about reinsurance. All right, a non-for-profit insurance provider operated by an organization, operates on a lodge system, exists for the benefit of its members, is called non-for-profit. I think it's fraternal. I think mutual is for profit. All right, which insurance company function calculates company mortality and morbidity rates, as well as dividends on participating life insurance policies? I'm going to guess underwriting. An insurance company that primarily sells life insurance policy designed for burial and last expense purposes, whose agents typically collect premiums in person, is they sell life insurance policies. Okay, so I don't think it would be home. Maybe it's a reinsurance. All right, let's see how we did, or I did. All right, so I pretty much failed this. All right, so the answer here, reinsurance, is everything's correct except claims are paid to the policy owner separately by each insurer participating in the reinsurance agreement. All right, so this one up here is correct. It is a risk-sharing process. When insurers underwrite, especially large policies, they typically try and spread the risk. Okay, green is correct. Okay, this is probably the only one I got right. Fraternal Insurance Company. They are not-for-profit organizations that specialize in life insurance and annuity products. They're available only to society members. So the next one is Actuary Division. It calculates company mortality and morbidity rates, as well as dividends on life insurance policies. So this exam here, they include Maryland Life, Accident, and Health. I'm mainly going to be focusing on health when I pass my exam, but you have to know the life insurance as well. And in case you ever get, somebody is interested in it, you'll know. All right, the next one is Home Service Insurance Company. And this sells life insurance policy primarily for burial and last expense purposes. Okay, Home Service Insurance Companies. All right, so that's the end of this lesson here, which I guess we're going to call insurance providers, all right? And lesson 3 might just be for Maryland because it says Maryland General Insurance Laws. So if you're not interested in lesson 3, you can skip that one. And I will see you on the next video.